Personal risk management. What is risk? For the purposes of this discussion, we will define risk as the potential for significant financial loss. Insurance is a very expensive way to deal with risk, and it should be your last choice, not your first. In the prior videos, we talked about modern insurance being divided into two parts: risk transfer and risk funding. Risk transfer is when the catastrophe is of such a magnitude that it cannot be borne by the individual and must be shared as society as a whole. Hurricane Sandy would be an example. Risk funding. I like to refer to this as paying for your losses on the installment plan. The loss may not be catastrophic in nature, but still represents a financial hardship. In these situations, the value the insurance company adds are claims management, risk financing, and risk timing. An example, most people can afford a broken windshield. However, two in the same month can be a bit challenging. Basic principles. Never risk more than you can afford to lose. A substantial investment such as one's dwelling requires a homeowner's policy. Never risk a lot for a little and never pay a lot for a little. I can buy a homeowner's policy with a $1,000 deductible or a $25,000 deductible. The difference in premium can be as little as a few $100s. Never pay a lot for a little. When you're paying a lot of money for a small amount of insurance, it usually indicates an inefficient market. There are many technical reasons as to why this is true, but it usually means that the spread of risk is not sufficient to determine value pricing. An example would be long-term health care. Not enough people bought it, and as a consequence, the price was artificially high, which caused less people to buy it, which caused the price to continue to rise. As a result, most major insurers have withdrawn from the market, and the ones that are left write very limited contracts. When buying insurance, always consider the odds. What personal risk management does, it adds a disciplined approach to managing the hazards of life. It does so by applying the following principles: risk avoidance, reduction, risk retention, and risk transfer. Risk avoidance. Don't get the pit bull, rethink the trampoline. Perhaps a swim club makes more sense than a backyard pool. Reduce risk. Get the broken sidewalk repaired. Store the gasoline lawnmower outside the house. Have a diamond ring setting checked from time to time. Jewelry that is not frequently used should be in a bank vault and not a dresser drawer. Risk retention. It can either be voluntary or involuntary. Voluntary risk retention means you've acknowledged your exposure and made a conscious decision that you have the financial ability to absorb the consequence of that loss. Involuntary risk retention is when you suffer a significant financial loss that was not anticipated. Risk transfer. Risk can be transferred by contract. A lease can transfer your responsibility as owner of a property to the tenant who is renting the property. The usual type of risk transfer is a policy. For $1,000, the risk of your house burning down has now been transferred to an insurance company. So to recap, risk is the possibility of significant financial loss. Once we've identified the risk, we can avoid it, retain it, reduce it, or transfer it. The basic philosophy governing personal risk management is: never risk more than you can afford to lose. Never risk a lot for a little, and never pay a lot for a little. And always consider the odds. Remember, purchasing insurance should be your last choice and not your first. I am designing these YouTubes for people whose insurance is important to them. If you need more information, please contact me. My name is R.DiForte, and thank you for watching.